One fear that many investors and traders have is finding the wrong investments. We're worried that we're getting into one kind of investment that doesn't perform very well, when really we should be in different types of investments. If that is a concern that you have, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. One big fear that individual investors have is the same thing that can plague even big-time investors: the wrong investments. We get into an investment that we think will really perform well, only to have it turn into a dog. Or, even worse, have it go in the opposite direction. Some individual investors really don't care about the investment itself. They're worried more about price action. That's why a lot of the big flyers, like Amazon, Apple, Google, Tesla, those shares trade millions and millions of shares every day because there is real price movement. As other participants see that price movement, they get involved, which makes even more price movement occur. Others want to get in a good quality investment, something that they believe in the company, they believe in the products that that company produces or the services that they provide, but then things go wrong and something happens. And you're not only disappointed with the value of your investment, but you're disappointed in what you invested in. So there's a real problem with finding the wrong investments. One problem that people have is that there are thousands of investments to choose from. How do I know how to pick a good investment? There are thousands of stocks. There are thousands of mutual funds and thousands of ETFs. And that's just mainly in the stock market. Then you have bonds, futures contracts, there's foreign exchange, there's cryptocurrencies, and there's many other types of investments as well. How do you know which one to choose? What I teach in the classes that I provide is we've already made that choice, and we focus on that investment because this investment can do pretty much anything we need it to do. The solution can be for you to consider index investing. Instead of spending all this time trying to find the next latest and greatest Microsoft or Apple, consider looking at an index. The stocks in that index are already chosen for you, and you just have to follow the index itself. This may not work for all investors, but this can play a critical role in your overall portfolio. You may invest in some indexes, but at the same time, you may have individual investments as well. This can include the index called the Dow Jones Industrial Average, and that's probably the most famous. It's been around a long time. It's made up of 30 stocks that they change periodically. Typically, when you're following the financial media, if they say the market's up 1,000 points, down 1,000 points, they're talking about the Dow. So it has become pretty much the benchmark that is used to determine, is the market up today or down today? Another index that I actually prefer is the S&P 500. A minute ago, I said that the Dow has 30 stocks. Well, there are over 500 stocks currently in the S&P 500, hence the name. This allows for a broader spectrum. So if you invest in the S&P 500, you're getting a little bit of Microsoft, a little bit of Google, a little bit of Disney, a lot of the big names that you probably have heard of, and a lot of companies that you may not have heard of. Another index is the NASDAQ 100. In the US, there are two main exchanges. There's the New York Stock Exchange, and then there's the NASDAQ. Now, a lot of the technology overlaps, but a long time ago, The NASDAQ was created to allow for advancements in technology, where the New York Stock Exchange did it the old-fashioned way through open outcry and the auction system. Over the years, both the NYSE and the NASDAQ have become very popular. There are thousands of stocks that trade on the NASDAQ. What they've done is they've taken the 100 biggest companies, and this includes Apple, Microsoft, Amazon, usually stocks with 4 letters in their symbol. Those are stocks that trade on the NASDAQ. You can invest in this index. This allows for diversification. The idea is if you have a certain amount of money, let's say $1,000, do you want to take that $1,000 and put it into one stock? Well, that can be really good if the price goes up. Now you're seeing a profit, at least on paper. What happens if the price goes down? Now you're losing money. Now, I'm not saying you will avoid that using an index fund, but that same $1,000 goes into a little bit of Microsoft, a little bit of Amazon, a little bit of Google. So you're spreading things out across the whole array of investments instead of putting all of your money into one investment. The idea is don't put all your eggs in one basket. We use that as a cliche. Have a little bit in many different places. A lot of times what happens, even within an index, if there are certain stocks that go down, other stocks tend to go up. Now, overall, the index may go up or down, but they have a way of balancing each other out, and they can offset. Years ago, somebody made the statement, there's always a bull market somewhere. Even when we're going down, even when prices are really declining quickly, there are still other stocks that go up, because they're based in different types of businesses that actually benefit when some prices go down. The idea here is to spread your money across a larger array so that you'll see overall success. So spread your investment out over different time frames as well. When I'm talking about time frames, there is short term, which I define as days to weeks. Now there's even day traders that trade in and out during the day. I don't do that. I don't teach that. I don't even condone that. It serves a necessary role, but it's not where I go with things. Intermediate term is weeks to months, and then long term is months to years or even decades or generations. You can have some investments that are more short term in nature. Maybe you're doing something every month. There are investments that allow you to do things every week. Then there's other investments that you hang on for a little bit longer, maybe a few months. That's more of the swing trading type of approach. And then you have other investments which you just hang on to no matter what happens in the markets. So you can mix and match across multiple time frames. If you have some extra time, you may look at implementing some short and intermediate term strategies. If you don't have a lot of time, you may just stick with the long-term investments. Another problem is every time I get into an investment, I lose money. Okay, think of this. Every time you buy a stock, it goes down. Every time you go to a baseball game, your team loses. Every time you want to drive on the freeway, there's traffic. I hate to break this to you, but we are not the center of the universe. Things don't happen because of us. We don't have that much control. Just because I get into an investment and it goes down, I didn't cause that. I may think that's what happens, but that's not reality. That's not what's really going on. You just got in at the wrong time. You just went to see your baseball team on a bad day. Or you got on the freeway during rush hour. It's not all about us. Believe it or not, people really struggle with this. They think that there's some curse on them and that anytime they want to do something, it's going to do the opposite. And so what do? Either nothing, or they turn over their management to somebody else, or they get their advice from other people instead of making the decisions themselves. Another solution to this is using a thing called technical analysis. This uses charts. So instead of just rolling the dice and hoping that you're getting in at the right time, or just making your decision, okay, I'm going to get into me some Microsoft tomorrow, you actually look at some charts and come up with, is this a good time to do that? It's in a real downtrend right now. Maybe I should wait until I see an uptrend start to develop. Technical analysis can be a useful tool, and I teach lots of classes on just technical analysis. So this can assist you in assessing current conditions and timing. Some people don't really like this. They think you can't time the market. It doesn't work. Well, yeah, it doesn't work because people aren't implementing things the right way. If you know what you're doing, if you develop a skill, this can be a very powerful tool that yields really good results for you. So I want to thank you for taking the time to watch this video. I appreciate that very much. Please leave a like or a dislike and any comments that you may have. I like lots of feedback. Also, consider subscribing to this channel. It'll help it grow by clicking on the bell to be notified anytime I post a new video. Also, as I said at the beginning of this video, please feel free to access the workshop. Also, I have a blog at spxinvestingblog.com where I write articles. They're pretty much the same as these videos, but they're in writing rather than listening to me and watching me on a video. So thank you very much, and I'll see you in the next video.